Let me be direct with you right now, because nobody else on this platform has the nerve to say this to your face. The United States of America is sitting on a debt time bomb, and the clock is not just ticking, it is screaming. Gold reserves today cover just 3% of total U.S. federal debt. 3%. In 1980, that number was 18%. In the 1940s, it was above 50%. You do not need a PhD in economics to understand what that gap represents. That gap is decades of fiscal cowardice, monetary manipulation, and political spinelessness compressed into a single devastating chart. And right now, while you are watching YouTube videos and debating whether to buy a little gold ETF with your spare change, sovereign wealth funds, central banks, and the smartest money on the planet are accumulating hard assets at a pace this world has not seen in a generation. The question you need to answer today, not tomorrow, not after the next Fed meeting, today is, which side of this trade are you going to be on? Every single week on this channel, I break down the macro forces that are reshaping global wealth with the kind of precision and depth that institutional investors pay their analysts hundreds of thousands of dollars a year to produce. You are getting that same level of analysis completely free, right here, right now. The only thing I am asking you to do is hit that subscribe button and turn on notifications. If you cannot do that one simple thing in exchange for intelligence that could legitimately protect your financial future, then I genuinely cannot help you, and you should probably stop watching. Now let us get into the numbers, because the numbers are where the truth lives and the truth is uncomfortable. There is a chart that has been circulating among serious macro investors, originally highlighted by Tavi Costa and amplified by the Kobayashi letter. And what it shows is a relationship between U.S. gold reserves and total federal debt, expressed as a percentage. Today, that ratio sits at approximately 3%. That means if you took every single ounce of gold that the United States government claims to hold in its vaults, marked it to the current market price, and divided it by the total outstanding federal debt, you would get 3 cents of gold coverage for every single dollar owed. 3 cents on the dollar. When that same calculation was run in 1980, the answer was 18%. Minus 6 times higher than where we are today. And if you go all the way back to the 1940s, when the Bretton Woods monetary order still tied the dollar to gold with some degree of discipline, that coverage ratio was above 50%. 50%, more than half of every dollar of federal debt, was backed by gold in the National Reserve. So what does the math say? If you want to restore the 1980 ratio of 18% using today's debt level, gold would have to increase by roughly 400%, from around $5,000 an ounce to somewhere in the price neighborhood of $26,000 per ounce. And if you want to restore the 1940s ratio of 50%, gold would have to rise nearly 1,400% to approximately $75,000 an ounce. These are not numbers I invented. These are not primable fantasy projections from someone trying to sell you a gold coin subscription. These are the mathematical outputs of a straightforward ratio calculation applied to publicly available government data. The numbers say what the numbers say. The real question, and this is where most retail investors completely lose the plot, is what exactly these numbers are telling you and what they are not telling you. Here is where I have to be brutally honest with you, because intellectual honesty is the only thing that separates serious investors from the noise machine. The ratio argument, the idea that gold must go to $26,000, because that is what it would take to restore the 1980 coverage level, is not a valid price target logic on its own. And I want you to understand exactly why, because if you internalize this, you will be a smarter investor than 90% of the people sharing this chart on social media. Think about this thought experiment for a moment. Canada, one of the wealthiest nations on earth, a G7 economy, a country with significant natural resources and a stable government, holds zero gold. They have held zero gold for approximately the last 10 years. They are the only major developed nation with no gold reserves whatsoever. Now, if you applied the same ratio logic to Canada, you would ask, how much would the gold price have to rise so that Canada's gold reserves cover the same percentage of its national debt that they covered historically? And the answer is infinity. The price of gold could go to $1 trillion an ounce, and Canada's coverage ratio would still be zero, because 0 times anything is still 0. That is obviously an absurd conclusion, which means the ratio itself cannot be a mechanistic price target. Gold does not have to go to $26,000 simply because the math of the coverage ratio says so. But, and this is the critical distinction that most people miss entirely, the fact that this specific conclusion is flawed does not mean the underlying signal is meaningless. Far from it. What the chart is actually screaming, with the full force of decades of historical data behind it, is that the growth of U.S. federal debt has been so explosive, so relentless, and so completely untethered from economic reality that even with gold at $5,000 an ounce, a price that would have sounded insane to most Americans 15 years ago, the coverage ratio is still near the lowest level ever recorded. That is the real signal. Not that gold must hit a specific number by a specific date. The real signal is that U.S. debt has expanded so far beyond any reasonable measure of fiscal discipline that the traditional relationship between sovereign obligations and hard asset reserves has been completely obliterated. And when those historical relationships break down to this extreme a degree, history has a very consistent habit of reasserting itself violently, unexpectedly, and at great cost to anyone who is not positioned correctly in advance. So let us talk about the debt itself, because I want you to feel the weight of what we are actually dealing with here. Total U.S. public debt as a percentage of GDP, the debt to GDP ratio is currently sitting above 115%. Let me give you the context for why that number should terrify you. Before the COVID pandemic, the ratio was already at a historically elevated level of around 102 to 1, 103%, which was itself considered dangerously high by serious economists. Then COVID hit, spending exploded, and the ratio spiked dramatically upward. After the immediate crisis passed, the ratio came down slightly, but it never returned to pre-COVID levels. It stabilized at around 115%, and it has not looked back. And here's the part that should make your blood run cold. The debt to GDP ratio has been increasing not just during recessions, not just during wartime, not just during crises. It has been increasing during economic expansions, during peacetime, during periods of historically low unemployment. In other words, even when everything is going well by conventional measures, America is still borrowing more than it is producing. The debt is growing faster than the economy in every single economic environment. That is the textbook definition of an unsustainable trajectory. Now look at the annual budget deficit expressed as a percentage of GDP. What you see when you map this out historically is a pattern that should shock you into action. The deficit is not just growing during bad times. The entire distribution is shifting downward. The peaks are worse than they used to be. The troughs are worse than they used to be. The trend line is unmistakably moving in one direction, and that direction is deeper into deficit year after year, regardless of who controls the White House, regardless of which party controls Congress, regardless of whether the economy is booming or contracting. I want to be absolutely clear about something. This is not a Republican problem, and it is not a Democrat problem. It is a systemic problem baked into the very incentive structure of modern democratic governance, combined with a fiat monetary system that allows unlimited deficit spending without immediate visible consequences. Politicians get elected by promising things and spending money. They do not get elected by imposing austerity and fiscal discipline. The system rewards spending and punishes restraint. And so that is exactly what you get. More spending, more debt, more deficit every single year, compounding on top of itself like a cancer that no one has the political courage to treat. Now we arrive at the most important part of this entire analysis, because understanding the problem is only half the battle. The other half is understanding what the government's options are for dealing with it, because those options, every single one of them, have direct, powerful implications for the price of gold. There are essentially 5 paths available to any government facing a debt crisis of this magnitude, and I'm going to walk you through each one with complete clarity. The first option is financial repression. This is the government's favorite tool because it is the most politically invisible. Financial repression means deliberately keeping interest rates below the rate of inflation for an extended period of time, which effectively erodes the real value of outstanding debt without anyone having to vote for a painful measure or stand up at a podium and announce a haircut. So every year that real interest rates are negative, the purchasing power of that debt is quietly destroyed. The creditors, the people who bought those treasury bonds, who lent money to the government, are being paid back in dollars that are worth less than the dollars they lent. This is inflation as a policy tool, and it is as old as sovereign debt itself. Now, what does financial repression do to gold? It is rocket fuel. When real interest rates are negative or near zero, the opportunity cost of holding gold, which pays no yield, essentially disappears. Gold becomes one of the most attractive stores of value available because everything else that is supposedly safe is being quietly confiscated by inflation. Financial repression is unambiguously and powerfully bullish for gold. The second option is fiscal tightening, actually cutting spending, raising taxes, reforming entitlement programs, and doing the hard, painful work of bringing the government's balance sheet back towards sustainability. This is the responsible path. It is also the political death sentence. The moment a politician proposes meaningful cuts to Social Security, Medicare, defense spending, or any other significant budget line, there is an identifiable, vocal, organized constituency that will mobilize against them with everything they have. And the moment taxes are raised on any group, individuals, corporations, investors, anyone, those people know exactly what was done to them and exactly who did it. Fiscal tightening is going to have to happen eventually in some form because the math demands it. But it will be delayed as long as humanly possible, implemented reluctantly, and watered down by political compromise until it barely resembles actual fiscal discipline. And even in the scenario where it does happen meaningfully, higher taxes on economic activity tend to reduce the very productivity and output that would be needed to grow your way out of the debt problem. Which brings us to option 3. The third option is genuine, large-scale economic growth. If the U.S. economy could sustain productivity growth and output expansion at a rate significantly higher than the rate at which debt is accumulating, you could theoretically grow your way out of the problem without cutting spending or raising taxes. This is the dream scenario. It is possible. Artificial intelligence, energy innovation, and technological breakthroughs could, in theory, generate productivity gains large enough to matter. But here is the cold reality. Even in the most optimistic growth scenarios, you would need to sustain extraordinarily high growth rates for an extended period of time without encountering any recessions, crises, geopolitical disruptions, or natural disasters, and without allowing the fiscal situation to deteriorate further in the meantime. History says that kind of sustained, uninterrupted, debt outpacing growth does not happen. It has never happened at the scale required. And if you simultaneously try to impose fiscal tightening through higher taxes on businesses and investors, you directly undermine the conditions needed for the growth to materialize in the first place. Options 2 and 3 are in direct tension with each other, which is exactly why governments almost never successfully execute both simultaneously. The fourth option is monetary intervention, quantitative easing, yield curve control, and whatever creative rebranding the Federal Reserve invents to describe the next round of balance sheet expansion. The Fed recently ended its quantitative tightening program. The market is already beginning to price in the likelihood of renewed asset purchases within the next several months, regardless of what they choose to call it. Every time the Fed expands its balance sheet, every time it suppresses long-term yields through asset purchases, every time it signals that it will stand behind the Treasury market, regardless of the fiscal situation, it is doing one thing above all others. It is debasing the purchasing power of the currency it issues. And gold, which is the oldest and most reliable hedge against currency debasement that human civilization has ever devised, responds accordingly. Monetary intervention on the scale that the current debt situation demands is not a possibility. It is a near certainty, and it is categorically, unambiguously, powerfully good for gold. The fifth option is what nobody wants to say out loud: a disorderly outcome. a financial crisis triggered by a loss of confidence in U.S. Treasuries, a geopolitical shock that accelerates dollar reserve, diversification globally, a war that expands beyond current theaters and creates emergency fiscal pressures that overwhelm any remaining budget discipline, a cyber attack on financial infrastructure, another pandemic, a natural disaster of unprecedented scale. The specific trigger does not matter. What matters is that when a system is this leveraged, this fragile, and this dependent on continuous confidence and continuous debt rollover, any significant shock can trigger a cascade that is wildly disproportionate to the initial disruption, and in any disorderly outcome, any scenario where confidence in the system itself is challenged, gold is not just a good investment. Gold is the only investment that has historically preserved wealth through the complete collapse of monetary systems. The takeaway from all 5 of these options is the same. Gold wins. Every path leads to the same destination. Financial repression means currency debasement, which means gold wins. Fiscal tightening gets delayed and undermined, meaning the debt keeps growing, meaning gold wins. Growth alone cannot outpace the debt accumulation, meaning other measures will be required, meaning gold wins. Monetary intervention is the most likely near-term response, meaning direct currency debasement, meaning gold wins. And a disorderly outcome means gold wins most dramatically of all. So what does all of this mean for how you should actually be positioning your portfolio right now, today, with real money and real consequences? Let me be specific, because vague macro commentary that does not translate into actionable positioning is completely useless to you. First, you need to understand that the question is no longer whether gold belongs in your portfolio. That debate is over. The question is how much and in what form. I have said for years that a serious, informed investor in the current macro environment should have a meaningful allocation to gold, not a token 2 or 3% sprinkled in as an afterthought, but a real, deliberate, significant position that reflects the severity of the fiscal and monetary situation we have just walked through together. The specific percentage that is right for you depends on your overall financial situation, your risk tolerance, your time horizon, and your existing portfolio composition. But I will tell you this, if you are looking at the data we have discussed today and you have less than 10% of your investable assets in gold or gold-related instruments, you are making a decision that the numbers do not support. In terms of form, the allocation should not be monolithic. Physical gold coins, bars, allocated vault storage through reputable custodians gives you direct exposure without counterparty risk. And counterparty risk is precisely the kind of risk that becomes catastrophic in the disorderly scenarios we discussed. Gold ETFs backed by physical gold, such as those that actually hold allocated metal on your behalf, give you liquidity and ease of trading. Gold mining equities give you leveraged exposure to the gold price when gold rises. Well-run miners with low production costs can see their earnings expand at a multiple of the gold price increase, which means their equity prices can dramatically outperform the metal itself. A thoughtful allocation uses all 3 of these instruments in proportion to your specific objectives. On price targets, and I want to be measured here because unlike the ratio-based logic we debunked earlier, I believe in targets that are grounded in macro fundamentals rather than simple ratio restoration. Gold at $10,000 an ounce within the next 3 to 5 years is a scenario that the current macro environment makes entirely plausible. That would represent roughly a 100% increase from current levels, driven by the combination of monetary intervention, continued deficit expansion, global de-dollarization, and central bank accumulation that is already well underway, a scenario that involves a more disorderly fiscal or monetary event could take gold significantly beyond that level on a faster timeline. But you do not need to model the extreme scenario to justify the position. The base case alone, financial repression, continued deficits, renewed quantitative easing, is more than sufficient to make gold one of the most compelling macro trades of the next decade. The timeline for this trade is not a week and it is not a month. It is years. And the single biggest mistake most retail investors make with gold is that they buy it. They watch it go sideways for 6 months They get impatient, they sell it, and then they watch it rip 300% while they are sitting in cash wondering what happened. Gold is not a momentum trade. It is a macro position. It requires conviction, patience, and the discipline to hold through periods of consolidation and even drawdown because the forces driving it, debt accumulation, monetary debasement, geopolitical realignment, operate on timescales measured in years and decades, not days and weeks. If you understand the thesis, if you believe the numbers, and if you have sized the position correctly so that you are not forced to sell at the wrong moment, then time is entirely on your side. I am going to lead you with a simple binary choice, because at the end of the day, that is exactly what this comes down to. On one side of that choice, you can dismiss everything we have talked about today. You can tell yourself that the debt will somehow work itself out, that politicians will find the discipline to do what they have never done before, that the Fed will somehow normalize policy without triggering a crisis, and that gold is an outdated relic that belongs in a museum rather than in your portfolio. You can make that choice. Millions of people are making it right now. And if history is any guide, if the last 100 years of monetary history means anything at all, those people are going to pay an enormous price for that complacency. On the other side, you can look at the numbers, accept the reality of what they are telling you, and take deliberate, informed, measured action to protect your wealth and your family's future before the consequences of this debt spiral become impossible to ignore. The government has 5 options. Gold wins in 4 of them overwhelmingly and survives the 5th. This is not a complicated decision once you strip away the emotion and the noise and just follow the math, do the work, protect your position, and do not say you were never warned.